Good afternoon, everyone. Welcome to today's webinar, How to Use Options to Generate Positive Cash Flow. My name is Scott Green, Marketing Director with Regal Securities, and shortly I'll be introducing today's presenter, Mark Benzaquen from the Options Industry Council and the Options Clearing Corporation. Along with today's topic of how to use options to generate positive cash flow, we'll touch on topics such as income generation, risk protection, stock acquisition, short-term and long-term outlooks, and more. And after I introduce Mark and he goes through his presentation, we'll have time for Q&A at the end. The entire time of this webinar will last about an hour, so we'll try to wrap it up around 4:15 Central Standard Time. And in the meantime, at any point, if anybody has any questions, please enter them into the chat box or the Q&A box in the webinar platform, and we will address them at the end. And actually, now would be a good time to use that. So I have a question for everyone. Who has traded options before? In the chat box or the Q&A box, please either respond Y for yes or N for no if you have not traded options before. And I'll just take a quick look at some of the results here. And so it looks like just about everybody, we have a couple no's, but just about everybody has traded options before. Got a few there, so maybe 90% or so have, which is fine, because this is a topic for people of all kinds of experiences. And please feel free to just submit questions at any point, and we'll get to as many as we can at the end. So next, just want to take a moment to share this disclaimer. The types of securities, forms, and research tools used in this webinar are for demonstration purposes only and should not be considered a recommendation by Regal Securities or a solicitation or an offer to buy or sell any options. This webinar is being recorded and is not intended to be used for individual tax, legal, or investment planning advice. We do get a lot of questions about recording. So yes, this webinar is recorded and it will be sent out to everyone via email. If you registered for this webinar, you'll receive a copy of this recording, a link to it to watch again. And so now I just want to introduce today's presenter, Mark Benzaquen. As I mentioned, he's an instructor at the OIC, and he's a Senior Investor Services Specialist at the OCC, the Options Clearing Corporation in Chicago, Illinois. Mark has spent over 20 years in the finance industry. At the OIC, he responds to complex inquiries from investors, brokers, and other industry personnel, and provides support for information education for all products on the OCC exchange. And at the OIC, excuse me, he's a certified instructor responsible for doing live webinars such as this and helping create their online content. So with that being said, now I want to hand it over to Mark Benzaquen. Mark, go ahead.
Well, hello, Scott, and hello, everybody. Welcome. Scott, thank you for that tremendous introduction. I got to tell you, listen, with the build-up that you gave me, I'd be excited to hear what I have to talk about, because obviously you make me sound like some kind of genius. So very excited to be here and present on behalf of OIC and Regal Securities. And so, ladies and gentlemen, really, I appreciate you taking the time to join us today. We are going to be talking about how to use options for a positive cash inflow, certainly, hopefully, for a positive cash inflow. Before we get started, Scott had a couple housekeeping items to take care of. I have some as well. As Scott had mentioned, the things that we're going to be talking about are simply for educational purposes. We're not making any recommendations to purchase or to engage in options trading. And as a matter of fact, options involve risks and may not be suitable for everyone. If you don't have a copy already of the options disclosure document, you can get a copy from Regal Securities or by contacting the OIC. The OIC, for those that aren't familiar, we are a branch, an educational branch of the OCC Options Clearing Corporation. We are a not-for-profit group, and we offer free, unbiased professional options education. We do that primarily through our website, optionseducation.org. where we have online courses, podcast, videos. Like Regal, we do options webinars periodically throughout the month. And we also have live options help via our investor services desk. You can reach us at options@theocc.com. We support the listed options that trade on these national exchanges. It's 15 different exchanges. They've all consolidated and bought out and merged with other exchanges to where we have these 5 parent companies left. And that is where the bulk of the options volume happens. And as you can see, this options volume, something that we really like taking a look at. You can see that back in '73 when things got started, fairly low in terms of options volume. Not a lot of trading went on. I believe the very first day at the CBOE, when they only had calls to trade, there were about 16 different securities that traded options. Today there's well over 4,000, and as you can see with the turn of the century here and with the advent of electronic trading, weekly options, ETFs, for example, definitely a big option contract. The ETF, very, very popular, and you can see the surge in volume. So education is something that the OIC, we pride ourselves on. We like to think that that education also led to an increase in options. So let's go ahead and get started with what we're talking about today. First and foremost, before you do any trade, you need to make sure that it is going to be the right trade. So we're going to briefly talk about selecting the right strategy. We're going to take a look at the 2 key questions that you need to ask yourself prior to selecting an option strategy. And then in detail, the strategies that we're going to look at today are the income generators, or the more popular income generators, I should say. We're going to look at covered calls, cash secured puts, and then we're going to put them together into the covered combo, and we're going to look at examples of each and discuss why we would trade those. So speaking of why we would trade, let's go ahead and take a look at selecting that right strategy. The right strategy is key. Without the right strategy, we don't know what we're looking to do, what we're looking to accomplish, and how we're going to get there. And the 2 key questions that we need to ask ourselves is, what's our motivation and what's our outlook? Why are we doing this trade? One of the great things about options is their versatility, their flexibility. With options, we can use them to generate income, which is obviously what we're talking about today. You can use them to mitigate or protect risk in your portfolio, something that my colleague Ed Modula spoke about previously at his previous presentation with Regal. And then also stock acquisition, something that we're going to briefly touch on today. But what's our motivation? Why are we doing this trade? And then what is our outlook? Are we bullish or bearish? Do we have a neutral outlook on the stock? What's our forecast on volatility, or specifically implied volatility? Or do we think that's going to increase or decrease or stay the same? And what's our time horizon? Are we looking for a short-term investment? Are we looking for long-term protection for our portfolio, for example? What's that event horizon? So the things that we need to look at: why are we doing the trade? And where's the stock going to go, and how long is it going to get there? A phrase that we have when it comes to trading options is very simply, plan the trade and trade the plan. So we need to know what we're looking to do, how we're going to accomplish that, what's our game plan for accomplishing that. And then one of the things that I always point out to investors is it's not only important to know when to get into an option, right? When do you want to get into that trade? But it's equally as important, if not even more important, is when to get out of it. When we're talking about income generating strategies, one of the key components is premium, option premium. And with income generating strategies, when you sell an option, that premium that you receive is typically going to be the maximum gain that you can make on that option. If you sell an option for $2, the most that you're going to be able to make with that investment is $2. So the idea is, when is enough enough? Do you squeeze every penny out of that option until you get that maximum $2 profit? Or maybe when you hit $1 of profit, is that enough? And is that a good time to exit that exit that trade, take that risk off the table, and roll into something else, put on a new trade. So getting into the trade is obviously very important in terms of your timing, but getting out of that trade, that exit strategy, is also paramount. So knowing what strategy we want to do is going to depend on why we're doing it, and again, that time horizon. How long is the stock going to take to get there, and which direction it's going to go? So the strategies that we're going to be talking about today, first and foremost, is the grandfather of all income generating strategies, the covered call. For those of you that are familiar with the covered call, we know that it's a strategy where we are long stock and we're short an equivalent number of options. For those of you that aren't familiar with the covered call, is simply this: we can buy 100 shares of 100 shares of stock, or if we already have stock in our portfolio, we can sell one option for every 100 shares that we have against it. We're going to write or sell one or more option contracts, one or more call contracts. We're going to buy the equivalent number of shares for that stock. One short call for each long 100 shares. That's going to be that key formula there. And, again, we were talking, what's the motivation? What's the outlook? Here, our motivation is simply income. We want to increase returns. That premium that we receive, that is going to be part of our profit. We're looking to generate any additional income over that share price. If the stock goes from 50 to 52, well, we've made $2 on the stock. That's fairly easy to figure out. But if we sell a call against it, that premium is going to be added to that $2 profit, or that $2 increase in share price. So we're generating additional income over and above that. In terms of our forecast, what is our outlook? With covered calls, we have a neutral to moderately bullish outlook on the stock, and we're looking for it to trade within a relatively small price range. And the reason being is if we're exceedingly or excessively bullish on the stock, if we really think that thing's going to take off, then this is not the strategy for us. And we'll get into why that is in just a moment. But just like any other option that we sell, whether it's a call or whether it's a put, we have obligations. For those of you that have been trading for a while, I'm sure you've heard this phrase thousands of times: buyers have rights, sellers have obligations. When it comes to the covered call contract, we're long stock, we are short an option. We've sold that call. We now have the obligation. When we sell calls, that obligation is to deliver shares of stock at the strike price if we're assigned. That's our obligation. Our obligation is assignment. It's possible at any time before expiration, assuming we're looking at an American style option contract. And equity options, ETFs, those are American style. In return for that obligation, and in return for us accepting that obligation to sell shares at the strike price, we receive that option premium. That's ours to keep, regardless of what happens with the trade. So we had talked about, I had mentioned how if we're excessively or exceedingly bullish on the stock, then a covered call isn't the right trade for you. And this is the reason being, is because our upside profit is limited. We're going to get into an example in just a little bit, but if the share price exceeds that short call, then our obligation to sell those shares at the strike price, well, that obligation is assignment, and we are expecting to be assigned. So if the stock goes above our strike price, we're expecting that we are going to have to deliver those shares. So if the stock goes a couple dollars above, well, that's one thing. If it goes $50 above our strike price, we're still going to have to sell those shares. So we're not going to participate in that upward price movement. So again, if we're aggressively bullish on the stock, this is not the strategy for us. Our upside profit is going to be limited to the strike price minus what we pay for the stock, plus that call premium that we receive. That's going to be our formula to figure out what our maximum profit is going to be. And again, we'll look at that in just a moment with the example. Now, on the downside, this is where things get a little bit tricky. The covered call in itself isn't a very risky transaction. It's not a very risky strategy. Typically, when people think about selling calls, they think about naked calls, and that absolutely is the riskiest option trade that you can make. However, we're covered because we own 100 shares of stock. That stock, when we get assigned, that stock is going to cover that assignment risk for us. However, we do still have risk. If we do not get assigned, if the stock doesn't go up but goes down instead, we've got that dollar for dollar risk with the declining stock price. That downside risk is with the long stock. It's just as if we had owned 100 shares of stock to begin with. That's where our downside risk is. The option in this case offers only limited protection. The stock can go to zero, and we're going to lose every penny that we paid for that stock. If we pay $45 for 100 shares of stock, $45 per share, I should say, and the stock goes to zero, we're going to lose $45 per share. Now, the only upside to that scenario is that whatever we receive when we sold the covered call, that is going to reduce that overall loss. But still, it's a substantial downside potential. The likelihood of that is probably pretty slim. If you do see the stock starting to slip and starting to take some big hits, fall out of bed, typically you can always sell out of it and cut your losses there. So the likelihood of the stock going to zero is probably relatively zero. Let's go ahead and take a look at an example. I know probably like a lot of you, numbers might be a little easier to figure out in the sense of when you look at something, if we can quantify it, it might be a little easier to figure out. So here's our example. We're long 100 shares of stock, and it's currently trading $52. Again, our forecast, our outlook, we're neutral to moderately bullish. Why are we doing this? What's our motivation? Well, we want to generate income. It's a stable market. We don't really expect much to happen to these shares, and rather than the stock just sitting there at 52 and not generating any income for us, not generating any profit, we can sell a call against it to generate some additional income. Now, here's a key bullet point that a lot of people are a little hesitant about. You have a target sale price for the stock. One of the inherent qualities of a covered call is that you absolutely must be willing to sell those shares. Okay? A lot of people that we talk to say they want to trade a covered call, but they absolutely don't want those shares to get called away. And while we don't provide advice or make recommendations at the OIC, we provide them information that they have to be prepared for those shares to be called away. If they absolutely refuse to give up those shares, then this is not the trade for them. And everybody has a target sale price for stock, typically. You buy shares at 52, would you be willing to take a little bit of a profit? In this case, maybe sell them at 55 or 56 or 57? Quite possibly. If not, then maybe you can select a different share price, a different strike price. If even that isn't enough for you, that you're unwilling to sell these shares, then this is not the strategy that you should be looking at. In this case, we're willing to sell shares if stock price appreciates a little bit. So we're going to go ahead and sell an out-of-the-money call. In this case, we're going to select a 55 strike. We're going to sell it at $1.75 or $175 in the real world. That's going to be the premium that we collect. Now, when we look at our chart here, if stock doesn't move at all and at expiration it finishes at $52, well, you can see normally we wouldn't have made anything on the stock. But because we sold that call for $1.75 or $175, that's our net profit. Had we done nothing and just sat on the stock, we would have made nothing. By selling the covered call, we're going to profit $175. And that's if nothing happens. If the share price increases, as we somewhat expect it to, remember we were neutral to moderately bullish. If shares go up to 55, well, we're going to profit $3 on the stock because we're selling those shares at $55. We also collected the $1.75 up front. So our profit is $4.75 $475 per option contract. So normally we would have just profited $300 for the increase in their stock. Here we're profiting $475, a substantial increase percentage-wise over just the shares themselves. However, there's a trade-off. The trade-off here being if the stock continues past our strike price, we are maxed out in terms of what our profit is. Regardless of where the shares go, if they go to $60 or if they go to $600, we are committed to selling those shares at $55. We are obligated to sell them at $55 should we get assigned. So our maximum profit is going to cap out at $4.75 or $475 per option contract. Now on the downside, you can see that as the shares decrease in value, as the stock price decreases, as do the value of the trade. As we lose money on the stock, we lose money on the trade. However, those losses are somewhat mitigated by the $1.75 that we collected up front. If stock goes from 52 to 50, or say even down to 40, we're going to lose money on those shares because our risk is in that long stock. We are still long 100 shares of stock, and as you know, when you're long stock, if stock goes up, you make money. Stock goes down, you lose money. So we are going to lose money here. However, we're not going to lose as much because we collected that premium up front. If it's easier for you to visualize graphically, here we go. Along 100 shares, 52, we sold the 55 call at $1.75. Our break-even point is going to be $50.25. If we had to, if the stock decreased in value, where do we give back the $1.75 that we collected up front when we sold the option? If we bought shares at 52, we give back all of the $1.75 credit with shares of $50.25. So prior to entering this trade, if we were just long stock, our break-even point is the share price, $52. If stock is above 52, we make money. If stock is below 52, we lose money. Because of this covered call, it reduces our break-even point to 50.25. So if shares finish above 50.25 now, we make money. If they finish below 50.25, we lose money. So that's our break-even point. And then again, that maximum profit, if assigned, that's going to be our strike price plus the premium that we receive minus our share price up front, gives us our total, in this case, $475. That is our maximum profit for the trade. Okay? Fairly straightforward, very, very, very common trade. One of the most common strategies in terms of income generating. A lot of retirees use the covered call strategy because they've already amassed stock, and in this way they can put their portfolio to work for them. Now, a few things to think about. We're selling options, so we always need to be prepared for assignment. Now, in this case, is assignment good or is assignment bad? Well, it really depends. If you get assigned, typically it's going to mean, depending on your strike price, assignment is going to mean that you made money on the stock. Well, that's a good thing, right? It also means that obviously we collected money up front when we sold the option, so it means that we reached our maximum profit. Well, that always seems like a good thing in my book. So assignment isn't necessarily a bad thing. However, assignment means that we need to be vigilant. This is not a put it in the drawer and forget about it option strategy. It's something that you need to monitor. It's something that you're going to want to manage. You may not want to give those shares away. You may change your outlook. You may be moderately bullish on the stock, but something happens and it changes your mind to where now you are aggressively bullish, and now you're afraid to get assigned. And if that's the case, you simply close out your position, buy those calls back, and now you're just left with the long stock. Now you can ride it all the way up. The only sure way, and I know this sounds trite, but the only sure way to avoid assignment is not to have an assignable position. So if you are worried about assignment, then you will need to close that out. Again, I've mentioned that risk is in the long stock position. However, you do have a little bit of downside protection from the premium that we collected. But first and foremost, your strike choice, that is going to be paramount. That is going to determine where you sell those shares, if assigned, and how much profit you have leeway in terms of the stock price. From where you purchase the stock, from where you sell it, that's going to be your profit, again, plus the premium that you receive. So strike price, first and foremost, it's going to be a trade-off. The further out of the money you go with the strike, that's going to reduce the likelihood of your shares getting assigned. However, it's also going to reduce the credit that you receive when you put the trade on. You're going to collect less money. Less risk means less money. So if you, the further out you go away from the strike, the further out of the money we go, that's going to generate a lower amount of income for you in that strategy. So it's definitely going to be a trade-off. You're going to want to balance that, the risk versus reward, just like any other trade. So let's go to the put counterpart of the covered call, and that's cash secured put. One of the great things about cash secured puts, well, it just looks like we skipped over a bunch of slides here. Well, it looks like we skipped a few slides, so I apologize. I don't have the ability to go back. Cash secured puts, one of the great things about cash secured puts, I'm sure that people have heard of the phrase buy the dip. Cash secured puts gives us the opportunity to buy the dip. Typically, again, we're selling puts here, so we're looking at the money or out of the money options. Assignment is generally welcome and desirable, right? The idea being, back to the motivation and the outlook. The motivation of a cash secured put is one of two things: either income because we're selling options, or we want to buy the dip. We want to acquire shares at below current market prices. And one thing that you may do is, let's say you own the stock from $50. You like it at $50, well, you're going to love it at 45, right? So if stock goes down to 45 and you're bullish on the stock, you may want to buy more shares. So that's where this cash secured put comes in. It might allow us to buy shares below that current market price, because if we get assigned, right, now we are buying shares at that strike price. And we'll look at an example of that in just a little bit. But the way that it works is simply this. We're selling a put, and the reason why we call it cash secured is just that. We are setting aside an appropriate amount of cash in an account, preferably an interest-bearing account, even though interest, these days is fairly minimal. But we're setting the money aside, so should we be assigned, we have the cash to buy those shares. So that's what a cash secured put is. We're selling a put. Typically, it's out of the money, and we're setting aside money. We're setting aside cash to buy those shares should we get assigned. Our outlook here is that we think that the stock is going to fall by about 10% in the next couple months before returning to current levels, or even above, right? That's that dip that everybody talks about that we're looking to buy. So we want to buy the dip in this case. So with a couple months till expiration, stock's trading 50. We're going to sell the out of the money put, the 45 strike put, and we're going to collect $2 for that. And then we're going to set aside an appropriate amount of cash to buy those shares should we get assigned. And let's look at it graphically here. We've got our strike price of 45. So if the stock finishes below 45, then we are going to get assigned, and we're going to be required to buy those shares. If stock finishes between 43 and 45, we're going to have a profit. We're buying stock for 45, but we're actually getting paid $2 in order to do it. So our break-even point is going to be 43. Anything below that, theoretically, we lose money. Anything above it, we make money. Now, if the option expires worthless, let's say stock doesn't come down to 45. Remember, stock was trading 50. Let's say it goes to 48 or 47 or even 46. we're not going to get assigned on that put. We're not going to be required to buy shares for $45. So what we are going to have is that $2 when we sold the option to begin with. That is our maximum profit, assuming the option does not get assigned. If the option does get assigned and we have to buy those shares at 45, right? Well, now we're left with a long stock position. The option we get assigned, the option goes away. We have a long stock position, and our profit or loss is now a result of that long stock. So the way that assignment works here, specifically for the cash secured put, is we would pay our strike price times 100. That's why we have to set that cash aside. We pay our strike price times 100, and we receive 100 shares of the stock. So we pay $4,500, and we receive 100 shares of stock, which is valued at whatever the current market price of the stock is. We also receive $2 up front, so we pay $4,500, but we're really getting that stock for $43 a share. And again, that's where that break-even point comes in. Now, the problem with the cash secured put in trying to buy the dip is it's possible that you miss the dip. It's possible that you don't get assigned, and so you miss out on that buying opportunity. Stock was trading 50. We sold a $45 put. What happens if stock goes down to 47? Well, we don't get assigned. We could always decide to buy those shares for 47. You know, that's great when the option expires. So we can buy the shares for 47 versus 50 where they were currently trading. But, you know, what happens if the stock actually doesn't even come down? What if it goes from 50 to 52 to 55 to 60? We're going to miss out on an opportunity to buy those shares at, at the current market price of 50 or the then market price of 50. We missed out on that opportunity. So if we are bullish on the stock and we are adamant that we want to buy it, we may pay higher than a then market price, after the rally. How many times have we, been looking at a stock and saying, boy, you know what, it's trading $50 right now. It's a little too much. I think I'd wait until it came down to 48 and I'd go ahead and buy some shares. Well, next thing you know, it's trading 54 and it looks like it's continuing to go up. So you end up biting the bullet and you buy them for 54 and you're kicking yourself that you could have had them for 50, but you got greedy. I'm sure that you've all heard the phrase that we used to have on the trading floor, pigs get fat, hogs get slaughtered. And that's certainly a situation here when it comes to buying the dip, is there is an absolute chance that you will miss the dip. Also something to think about, if you do get assigned and you buy those shares, again, just like the covered call, you have a long stock position now. And with that long stock position comes risk. Those shares theoretically can go down to zero. So as I mentioned here, shares might not only dip, but plummet. So certainly something to think about. Again, that's where that outlook, really becomes an important and a crucial factor. And one of the things, I just want to digress for a second. One of the things about outlook is it's not static. It's not constant. It's not written in stone. You may think today that the stock is going to go, increase by 10%, or it may decrease. But tomorrow, news may come out, and you may have a completely different opinion. The point being is it's crucial and it's imperative to be flexible with your option trading. Always be prepared to take another look at your outlook. Keep an eye on how things are going with the market. Keep an eye on how things are going with the sector, and obviously keep an eye on how things are going and how you feel about that stock, because that outlook is going to be fluid. What you believe today may not be what you believe tomorrow. So, definitely be prepared to be flexible with that. Now, when we put the strategies together, we have what we call the covered combo. Now, one thing that I just want to touch on real quick before I get to the covered combo, there was a gentleman that I spoke with about 3 weeks ago, and he was a retiree. He's been trading options for a long time, and he tells me that, and this is something that we hear time and time again, he's been using the covered call and the cash secured put for years. That he starts out with a long stock position, writes calls against it, and he keeps writing calls against those shares until he gets assigned. Once he gets assigned, he has to sell the stock, and he gets paid. He receives his strike price times 100, and he delivers 100 shares of stock. So now he's got a chunk of cash. He's got that chunk of cash. He puts it in his trading account, and he sells a put, a cash secured put. And he holds on to that cash secured put, and he keeps selling them and selling them until he gets assigned. Once he gets assigned, he buys shares. Now he's long stock, and what does he do? He sells a covered call. And he keeps repeating the cycle, selling the covered call till he gets assigned, selling a cash secured put till he gets assigned, selling the covered call till he gets assigned, and ad nauseum. He keeps doing that month after month, year after year, and you just keep generating a stable, hopefully, keep generating a stable income, by selling options. Now, obviously, there's a risk. Anytime that you're dealing with options, right, the risk is involved. The risk in this case is, he's left with long stock positions, and those long stock positions can decrease in value. So the risk of doing what he's doing and so many others do is simply that the stock, rather than remain stable or slightly bullish, slightly increasing in value, it could substantially decrease in value. So obviously that there is a big risk to doing what he does and what so many other investors do when it comes to income generating strategies like these, for example, where you have a long stock position. But the point being is it's certainly possible to go from one to the other and back and forth and back and forth. Now, when you put the two together concurrently, that's where we have that covered combo. And again, we need to be flexible. The covered combo, if we get assigned on that short put, that means that we're able to buy stock below the current price of the market, which is great. If we get assigned on our short call, it means that the stock has increased in value, and we sell stock above the current prices. So it means that we made money if the stock goes up, and hopefully we're making a little bit of money if the stock goes down because we're able to buy those shares cheaper than where they were. So now we're short two options, and we spoke about assignment with both of them. And so now assignment is even more prominent now that we're short two options. But again, it's generally seen as favorable. If we get assigned on the short call, as I mentioned, it means that the stock went up and we made money. If we got assigned on the short put, it means that the stock went down and we were able to buy those shares at a below market price. Anytime that we are sellers of options, Theta is our friend. For those of you that aren't familiar with the concept of Theta, it's one of the pricing Greeks. Theta is also known as time decay. And it basically tells us this, that for every day that we near expiration, your option, all other things considered being constant, your option is going to lose a little bit of money. So Theta is our friend. Is the idea being option sellers is we want those options to expire worthless. We want those options to expire without value. So as the days go on and the time premium, that juice gets sucked out of that option, well, Theta is working in our favor. When it comes to our reward, right, our profit, again, we're option sellers. That's going to be limited, but it's going to be substantial because now instead of selling one option, we're selling two. And then, as I mentioned again, the risk is in the long stock. However, with the covered combo, it's going to be compounded because we may be long stock from the covered call, and we may be long stock from the cash secured put if we get assigned. And we'll get into that in just a little bit. But that risk again remains in that long stock position. So why would we do it? Again, we're back to the motivation and outlook. Why are we doing it? What do we expect to happen? So our motivation is that we want to make money, plain and simple. The covered combo, primarily income is the number one motivation. It also allows us to sell shares of stock if the price increases, buy more if it decreases, right? And we buy that dip Okay, and then with this particular example, we'll say that stock is trading $65. Here's our outlook. We think the stock is going to be range bound within the next, say, 6 weeks, somewhere between $60 and $70, maybe up 5, maybe down 5 from where it's currently trading, but we don't expect any big swings in the market. So what we're going to do is we're going to buy 100 shares of stock, or we're already long 100 shares of stock. We're going to sell the $70 call against it, and that's currently trading in the market for $1.50. We're going to sell the 60 strike put against it for $1.75, and we're going to have cash on hand to buy shares if that short put gets assigned. And you can see here that means that our net credit is going to be $325 per option contract. Now, you can also see that this is known as a covered strangle. You're selling a call and you're selling a put, an out-of-the-money call and an out-of-the-money put in the same expiry, 45 days in this case. That's a strangle. We're covering that strangle, or at least part of it, with long stock, and the other part of it with cash on hand. So covered strangle is also a term that the covered combo is known by. So let's go ahead and take a look at this. Let's get into the weeds a little bit further here. Here's our trade. We're short the 70 call, short the 60 put, long 100 shares of stock. Our maximum gain, and that is going to happen on the call side, right? Remember the covered combo. I'm sorry, the covered call. Our maximum gain is going to be our call strike minus our share price plus that total premium, just like it was with the covered call. If stock rises, it's going to get called away at our strike price, which is $70. We bought it for $65. It's called away at $70, so we sold it at $70. We made $5 on the stock. Plus, we made $3.25. We made $3.25 when we got into the spread to begin with. So our net gain, our net maximum gain, is going to be $8.25 or $825 per option contract. That also is going to be the maximum gain. Because remember, if stock goes to 100 or if it goes to 1,000, it doesn't matter. We are committed, we are obligated to sell those shares at our short call strike price of $70. Now on the put side, it's going to be a little bit different. Our maximum risk is going to be, and this is where things get a little bit ugly here. Our maximum risk is going to be our share price plus the put strike minus our net premium. And let me explain to you why that is and how that is. Theoretically, the market can go to zero. We're long 100 shares of stock that we bought for $65. We can lose that. We can lose every penny of that if stock goes to zero. So we lose $65 on the long 100 shares of stock. We're also short the put for 60. And if we get assigned on that 60 put, we're long 100 shares of stock for $60. Stock goes to zero, we've lost $65 a share, and we've lost an additional $60 a share on another 100. However, it's mitigated with the premium that we received when we put the spread on to begin with. But it's, as you can see, it's substantial, $121.75 per option contract. In the real world, that amounts to about $12,000. It's a big, big number, okay? But that will only occur if the stock goes to zero at expiration. Now, again, the likelihood of that stock plummeting to zero overnight is very, very, very slim. However, as with all option trades, there is risk, and this is the risk of the covered combo. You've got risk in the initial 100 shares of stock, and you've got risk in that short put. So it is compounded because you now have 200 shares of long stock if you get assigned on that short put. So, definitely something to keep in mind, the covered combo. It's definitely an advanced strategy, not for the faint of heart. However, again, this is certainly not a put in the drawer and forget about strategy. It's going to require monitoring. It's going to require management and vigilance. And again, like I said, the expectation that the shares are going to go from 65 down to 0 overnight, probably pretty slim. So let's look at this graphically. We've got our downside loss potential. Remember, that's compounded by the short put and the long stock. Our upside profit is capped by that short call. So if shares finish below $60, our short call is going to expire worthless. Our short put gets assigned, and we buy an additional 100 shares of stock for $60 with that cash that we had on hand. And now our new risk reward is a result of being long 200 shares of stock. So again, if the stock goes down to 40, now we're long 200 shares of stock, 100 from 60, 100 from 65, call it 62.5 on average. Stock goes down to 40, well, we've just lost $22.5 per share, a substantial amount. If stock is between our strike prices, between 60 and 70, both options expire worthless, the call and the put. We remain long 100 shares of stock, and then that 3 1/4 premium that we have, that gets added or subtracted to our or from our long stock to calculate our net profit and loss. Let's say stock finishes at 65, it doesn't move at all, right? Well, we're long 100 shares of stock from 65. However, we collected $3.25 when we sold the spread. So that is our that is going to be our profit at expiration based on where that share price is. And then if stock finishes above 70, just like the covered call, we are obligated to deliver those shares at $70 a share. So that short put expires worthless, our short call gets assigned. We sell those shares at 70. We no longer have a long stock position. And our resulting profit is going to be, as we had mentioned earlier, the strike of the call minus the share price plus the premium that we received when we sold the spread. So, you know, something to think about with this. It is neither a bullish nor bearish strategy. You're typically looking at range-bound or what we call sideways trading stocks. And our objectives. Why are we doing this? We either want to buy more stock below where it's currently trading, or we want to sell it above current market prices, or income. In a word, we want income. We're selling 2 options. We're going to generate some pretty heavy premiums there. But with a sizable reward comes what? Substantial risk. Again, anytime in the world of option trading, anytime you've got reward, you've got risk. Anytime you have risk, you've got reward. So it's definitely something to monitor, and it's something to look at. Now, here's the last bullet point, and it's something we really haven't talked about, implied volatility. Implied volatility, as it increases, means option prices increase. As it decreases, it typically means option prices decrease. Because we are a seller of options, we want those prices to decrease. We sold something at $3, we want it to go out worthless, so we keep all of that $3. If implied volatility increases, prices increase, that $3 spread may now be worth $4. And that's a no-no. That's not something that we want. So an increase of implied volatility, it's got a negative effect on us, whereas as we talked about that theta, the passage of time, that has a positive effect. So, you know, some things work in our favor, some things work against us. Regardless, it is going to require monitoring and really just, you know, being on your toes and knowing what you're getting into. So that is it in terms of the 3 strategies that we have. Real quick, before I turn it back over to Scott, I just want to make sure that you are familiar with the Options Education Program from the OIC. We have a MyPath assessment where you can take a quiz. Based on your learning, it will put you in a options education path, whether it's fundamentals, intermediate, or an advanced pathway of education. And obviously, you know, feel free to get in touch with us at optionseducation.org. Our email address, options@theocc.com, and then social media. We're on Facebook, Twitter, LinkedIn, as well as we have a YouTube channel where we archive our OIC webinars that, like Regal, are all recorded and available for viewing. So I'm going to turn it back over to Scott now. I'm assuming that we've got a good deal of questions. So Scott, what do you have for us?
Thank you so much, Mark, for going over all those great option strategies. Really good stuff. Just a quick question, Mark. Did you need to go back to any of those covered call examples? I know we a couple slides that were forwarded through a little quickly. Did you need to go back and look at any of those slides again before we answer some of these questions?
No, I think we're okay. It turns out, I was kind of looking at my notes, and it looks like I just skipped over one slide, but I was able to use my notes and address everything that was on it. So I think that we're okay with that. Thank you.
Okay, great. Okay, if anybody has, we have a couple questions to go over, but now's the time. If you have questions, please feel free to enter them in either the Q&A or the chat box, and we'll get to as many as we can. One question, do I pay to enter in the option arena? That's one of the questions submitted.
Do I pay to enter into the option arena? I'm not quite sure what they mean by that, but let me do this. If they're asking what I think they're asking, anytime that you do a trade, it's either going to cost you money or you're going to receive money. If you're a buyer, you're going to be paying to, put on a trade. If you're a seller, you're going to receive funds when you put on the trade. Now, from the seller standpoint, because we're talking about income generating strategies, from the seller standpoint, your trading firm or your brokerage firm is going to require what they call margin in order for you to enter into a position. They're going to make sure that you've got enough money to cover your obligation. So even though you're a seller and you're receiving money up front, you are going to need to deposit funds into a trading account to ensure to your broker that you've got enough cash to cover your obligation should you get assigned. If that's the question that you're asking, do you need to pay? That's how I would answer that. If it's a different question and I'm misunderstanding, I apologize. Maybe you can clarify, and I'd be happy to take another stab at it.
Okay, another question we have is selling calls versus long leaps.
Okay, selling calls versus long leaps. What we refer to as the poor man's covered call. And it's funny that you mentioned that. I'm actually going to be doing a presentation specifically on the poor man's covered call later in the month on our OIC website. But we talked about how the covered call was you're buying 100 shares of stock and then you're selling a call against it. Well, buying 100 shares of stock could be expensive. Look at, take some of the stocks out there today. Look at Amazon for almost $2,000 a share. 100 shares of that is going to be a pretty big chunk of change. Even your, Apple's at 200 plus, even if it's an $85 share stock, let's say, you buy 100 shares of that, that's $8,500 that, you've got to come up with, which is, a good amount of money. So what some people do is they will buy an in-the-money leap option. And for those that aren't familiar, a leap option is a long-term, it's called long-term equity anticipation securities, LEAPs for short. And new LEAPs will be listed next Monday, as a matter of fact, or this coming Monday for 2021, January 2021. So what it really is you're buying a long-term option, and which is going to be a heck of a lot cheaper than 100 shares of stock. And then you're selling calls against that. And the idea being is that if that short call gets assigned, just that with as it normally would be with the regular covered call, now you can exercise that long-term leap that you have and get the stock that way. This way you've got less upfront capital, maybe a higher return on investment because you've put less money into it. Instead of paying $8,500 up front for the stock, now maybe you're only at $1,500 for the the one leap option. So that, to answer the question, it's called a poor man's covered call, and that's how it works. It can be a great strategy. It's just like the covered call, with the exception that it requires less upfront capital.
Can you please clarify assignment and exercise?
Oh, certainly. Simply put, buyers exercise and sellers get assigned. Now, what does that mean? An option contract is just that. It's a contract between two parties. And Scott, let's say you and I are the parties in this option transaction. I buy, you sell. Now, we have an agreement. I am giving you money, and in return, I now have the right to buy 100 shares of stock at a specific strike price or at a specific price per share. You can look at it that way within a certain period of time. By accepting my payment, you now are accepting the obligation to sell me 100 shares of stock at that strike price within that specific period of time. Now, so that's the option contract. So, it's a contract between two parties. If I want to enforce that contract, I am exercising my right to buy those shares at the strike price within that time frame. So I'm telling you, Scott, hey, you know what? You and I, had a deal for me to buy, XYZ stock for $50 a share, and I paid you $3 for that right. I want to go ahead and buy that. Stock's trading right now $60. I want to buy those shares from you for $50, so I'm going to exercise my right to do so. I'm going to pay you $50 a share, and in return, you are going to give me 100 shares of stock. So that's how the exercise works, is I'm exercising my right. You, as the seller, you now have the obligation to sell me those shares. You are accepting that obligation, and the process by which that obligation gets fulfilled is called assignment. So buyers have rights, and they can exercise those rights. Sellers have obligations, and the fulfillment of those obligations is called assignment.
Great. Thanks for all the questions that are coming in. Here's another one. Advice for those who are just starting out. Would straight options, call or puts short term be wise to get to start off to get a good feel for options trading?
Absolutely. People ask, what is the number one thing that you would say to people, just getting into investors, just getting into options? First and foremost, start slow and start small. If you have the ability to paper trade or, what we call practice trading, definitely do that and get a feel for the market. But, buying calls and buying puts, when you open an account, there are different levels of trades that your broker will allow you to do. We had talked on how selling a call outright is the riskiest trade that you can make. Well, your broker is not even going to give you the option, or they're not even going to let you think about selling calls until you're a sophisticated trader who's been doing it for years. You know the risks in and out, and you've got a massive bankroll behind you. You've got money, behind you that you're not going to get crushed if that stock goes from 50 to 1,000. So, you're going to get approved for various levels of trading. And when you first get approved to trade, you're going to start at level one. Level one with most brokerage groups is going to be buying calls and buying puts. And absolutely, the old, the adage, you've got to walk before you can run. Same thing with options trading. Before you get, crazy and start, trading these complex spreads and complex strategies with all these moving parts, you need to know what you're getting yourself into. And the best way to do that is learn about calls and learn about puts and how they work, because those are the basics. There's really, when it comes down to it, there's four things that you can do with options. You can buy a call, you can buy a put, you can sell a call, you can sell a put, and that's it. Now you can combine those four things into, different scenarios, different combinations, but when it comes down to it, that's it. Those four things. And what I recommend to, you more advanced traders or more intermediate traders is there are dozens and dozens and dozens of strategies out there. Don't try to be an expert at every single one of them. Look at, maybe 2 or 3 bullish strategies, 2 or 3 bearish, 2 or 3 neutral, maybe a volatility strategy here or there or something. But the point being is, maybe get a half dozen, to 10 strategies that in and out for all these different scenarios and become an expert at those. Worry about the other stuff later. The more moving parts there are, the more legs there are on trade, the harder it's going to be to manage. And unlike stock, as I'd mentioned, you don't just put it in a drawer and forget about it. You need to monitor, you need to manage, and you need to be vigilant. So again, walk before you run, and start out slow, start out small.
All right. There's still actually a couple more questions. I don't know, Mark, if you got a couple more moments.
Yeah, I've got time.
Okay. One person asked to show the slide 32 again. Do you see slide 32 there, Mark?
I do.
I just pulled it up. They just asked to see this slide again. I don't know if you want to go over it one more time.
Okay. So this shows us what happens at expiration on the covered combo if stock finishes below $60. All right. So our short call is going to expire worthless. The short call gives us the obligation to sell shares at 70. If stock is trading below 60, nobody is going to want us to sell them stock at 70. So the short call expires worthless. Our short put, however, let's say stock is trading $50. Our short put obligates us to buy those shares for 60. So if stock's trading 50, we're going to have to buy those shares for $60 with the cash that we have on hand. Remember that we put aside. So our resulting position is going to be, we were long 100 shares of stock from 65 to begin with. That was part of our original trade. And now we bought an additional 100 shares of stock for $60 with our cash on hand. So our new position is long 200 shares of stock, which may be wonderful, or it may not. Stock right now is trading 50, let's say. So, we lost $15 on our first 100 shares that we had, and we lost an additional 10 on the second 100 shares. So we may decide to close the position there and take our lumps, or, we may look at it as, hey, here's an opportunity. Stock is, going to be heading back up into the $60 range or $70 range. So I'm going to hold on to it because I think the shares are going up. Again, it's that whole outlook thing. Where do we think the stock is going to go? So that's what this slide is. What happens if stock finishes below 60? In a nutshell, it's short call expires worthless, short put gets assigned, and we're now long 200 shares of stock.
Great, thank you. Just a couple more. This is a two-part question. If an option expires today, what is the latest time on the clock that the short position can be assigned? For example, is it 5 p.m. Eastern Standard Time, 1 hour after market closes? Question mark.
Okay, this is a little trickier. Let me look at it from the flip side to begin with. The OCC requires exercise notices. Exercise, not assignment, requires exercise notices to be. Well, let me rephrase that. The exchanges generally require exercise notices to be delivered by 5:30 p.m. Eastern Time, 90 minutes after the market closes. Okay, your broker will generally require have an earlier cutoff time because obviously they need to process those exercise notices. So definitely contact your broker, your trading firm, as to what their specific policy is, because it may vary from broker to broker. Now that's exercise. Assignment, believe it or not, there is no minimum time for an investor to be notified of assignment. We spoke earlier of the options disclosure document, the characteristics and risks of standardized options. It's a booklet that you will each receive when you open your trading account. And in that booklet, I believe it's, I'm kind of an options geek. I believe it's page 50 out of a 196-page document. I think it's page 50 or 51 that they talk about this. And what they tell you is that there actually is no prescribed time for you to receive notice. And the reason being is when all this started, the exercise, or I should say assignment notices came via the mail. And who knows when you would actually receive that notice from the U.S. Post Office. So the options industry could not put a deadline on it simply because they didn't have they didn't have control over when you would receive that notice. Now, in this day and age, with everything being, electronic, that rule hasn't been revised. However, it's a very rare situation where the investor is not notified by at least prior to the opening, the next day's opening of business. That's not to say that it doesn't happen, but it's a rare occurrence where that doesn't happen, where stock opens up or the market opens up the next day and the investor doesn't realize that that they were assigned. It seems, I don't want to say unfair, but it definitely is. It can put the investor in a precarious situation if they think that they have a short position and they're trading off of that short position, and it turns out that position has actually been assigned already. So it's one of the risks of selling options is that you may have you may have already been assigned, but you don't know it. And which takes me back to the talking earlier about assignment. That as trite as it sounds, as ridiculous as it sounds, the only way to avoid assignment is not to have an assignable position. You close out that trade at the end of the day, the end of the business day prior, and you won't have to worry about assignment.
And the other part of their question was, if an option expires out of the money, can the short buyer still exercise the option? And they give an example. They say, if I sell a put credit spread and short it at $200, and on the day of expiration, the market closes at $200.15, can I be assigned?
Well, absolutely, because that option's in the, if we're talking calls, that option's in the money. If you sold a $200 call as part of your spread, or just outright, you sell a $200 call and the market finishes at 215 cents, that option's in the money by 15 cents. So not only can you be assigned, but you're likely to be assigned. But taking it a step further, let's say you're short the 200 call and stock finishes 199.85. So in that case, the call is out of the money. However, one of the great things about being an option buyer, and again, I'm saying buyer, and one of the great things about being an option buyer is you are in the driver's seat. You're paying a premium for the right to exercise. Now, you can exercise for whatever reason you want, whenever you want. It doesn't have to be only in the money options. You can exercise at the money or out of the money. You could exercise for whatever reason you want, whenever you want. Now, why would you exercise in out of the money contract? Well, let's say that over the weekend or even overnight, I think that something is going to be happening. There's going to be a court ruling, or there's going to be an earnings announcement coming up, or there's going to be a drug trial result, whatever it may be, or maybe it's foreign companies that you're investing in, and there's going to be over the weekend there's going to be some developments that you think is going to cause that stock price to open up substantially higher come Monday. So you may choose to exercise your out of the money contract on Friday for $200, thinking that the stock finishes at 199.85. You're exercising that $200 call because the market's closed now, so you can't buy the shares, but you're going to exercise that call because you think the stock is going to open up come Monday for 210. So now you're exercising that out of the money call. You get those shares for 200. Stock opens up 210 on Monday. You're a happy man. The option seller is thinking, well, wait a minute. I've got a $200 call that I'm short. It's out of the money. I'm fine. I don't have to worry about assignment. Come Monday morning, you find out you were assigned, and theoretically you're $10 in the hole. So to answer the question, yes, out of the money options can be exercised at any time for any reason by the option holder. So again, option sellers, it's a risk that you have. It's something you need to be aware of. And again, the best way to avoid it is to not have an assignable position.
Great. Well, thank you so much again, Mark, for all the great insight, and thanks to everyone out there for attending and all the great questions. That's all the time we have. I know we had some questions that are left over. Please, everyone, here's our contact information. If you need some follow-up information, please reach out to Regal Securities, and we'll help you out as best we can. Again, big thanks to Mark Benzaquen of the Options Industry Council and the Options Clearing Corporation. They provide a lot of great content, and they're options experts on all this stuff, and they do a great job on our webinar series. And I saw there was a question. Yes, this is being recorded, and we will be sharing a link to the recording, hopefully in the next couple days. So be on the lookout for that email. And there will be more webinars coming up, so be on the lookout for those invites as well. Our next webinar is actually next Wednesday with Tony Zhang from Options Play and our Options Play series. So that's our next one, so you'll be receiving an email invite for that one too. But again, thank you again, everyone, for attending. If you have any questions, please contact us, and we'll be happy to address your question. And everyone, have a great rest of the day. Thank you.